Yeah, well, second week of April, we'll start to get earnings season, so we're right around the corner. But until then, we've been focusing on all this macro and wondering, what are rates really telling us? Is it recession? Or, is it just this manipulation by all this global easy money from the central bankers? And I think it's a little bit of both. I mean, clearly we're slowing, but international markets have been slowing for over 18 months. That's nothing new. And the U.S. market has been slowing, and the economy has been slowing since the second quarter of last year. That's not really that new. Obviously, to the extent of the slowdown is the key, but I actually do not think we're in a recession. So I do think a lot of the rates and the direction of rates is all of the central bankers really being very loose. And I look at why I say I don't think we're in a recession. I look at the consumer, and the consumer is doing pretty well. And actually, the data most recently in housing, mortgage rates, mortgage application rates, which you guys have been talking about all day, that is actually encouraging. And I expect autos actually to follow, given that rates are so low and the consumer feels good about their jobs and their wages. So I'm not looking at gloom and doom. I'm not looking for this great growth environment, but I'm not looking for gloom and doom. And I think as a result, that's positive for stocks.
I mean, if you look at the best performers so far this quarter, technology is on top of the S&P, up 18%, but the second best is real estate, which is sort of defensive, and the third is energy, and we saw that remarkable crude turnaround. That's part of the story there. So what kind of picture does this paint?
It's a little bit of various forms of defense. I think the energy move was mostly in the beginning of the quarter. So if you looked at March, looked at the past few weeks, I look at the 52-week high list every day. It is defensive type stocks or steady growth or predictable growth. It's not just conservative. A lot of it is very high PE multiple, very good growth stories like Ulta, Salons, or like a PayPal or something like that that's really working.
Today it was interesting. Did you see the 50? Yeah. Lots of consumer names that I cover. Kimberly-Clark was on there.
Estee Lauder. Exactly. Starbucks.
Yield. Dividend yield.
And a lot of it is it's yield or it's stable cash flows.
Yeah.
That's what the market kind of gravitates to when you're having a little bit of misgivings about exactly what the pace of underlying growth is.
Is it, Stephanie, also earnings? We got Lululemon, PVH last night impressing on the consumer side.
Yeah, I mean, absolutely.
Or are those just superstars in the group?
Oh, there are always superstars, Sarah. You cover them all, right? So I think
that's my point. I don't know that it's indicative of the U.S. consumer, honestly.
Right. I think that certainly companies that have strong fundamentals get rewarded. And by the way, both Lulu and PVH were a bit controversial headed into the quarters, right? You had a couple of downgrades on both companies. So I think they were good. They were good reports. They get rewarded for sure, but there are superstars. I do like the consumer a lot, as I just mentioned, especially with rates going in their favor and jobs going in their favor. But there are other parts of the economy that are very attractive. There are pockets of consumer staples that are doing very well. And again, to Mike's point, in terms of stable cash flow names, dividend yields, and the like, there's a lot to choose from in this kind of environment.